introducing an 8-figure hedge fund manager with accreditation from HSBC for global banking and financial markets.
I always tell my friends, trade your prop firms, but why don't you also try to create a track record so you can eventually get some investors on board. With prop firms, we don't know what's going to happen, if regulations will come in, if this is a bubble or not. And in order to have a backup, you need to create a track record. Worst comes to worst, you can always go that side.
Isar Chowdhury not only manages over $6 million of personal capital, but actually acts as an investment vehicle through his hedge fund to manage millions of dollars of other people's money. And with his KPMG audited track record, we know that we are joined by a verified trader that has a lot of insights and value to share.
We have different categories for trade setups. So we have AAA setups, AA setups, B grade setups. The lower it comes, the lower the risk becomes as well.
What would categorize a AAA setup for you?
The AAA would be a more premium case study. That means the biggest strategy that I can give you is risk management. Whatever strategy you want. I'm sure you trade a different strategy. I trade a different strategy. But if we both know how to manage the risk, we can both become profitable. A lot of people like to focus on the strategy and they like to hop on different strategies if one doesn't work, but they don't really focus on managing risk and perfecting that aspect.
When you take on the route that you had to get certain degrees, you had to also get certain audits, you had to probably prepare a track record. What is the realities of the benefits of taking this route that somebody may be thinking, what's the point? I can just max allocate with 10 prop firms and have a few $1 million and go from there?
It's a good question.
Well, it's going to be a special one because we've had a lot of traders on that are on social media, and a lot of them have different goals with their social media. It seems like you put a bit of time into content but with no objective, and more because you're on a more serious path, I want to say, which is managing funds, dealing with investors, big track records and so forth. So there's a lot of things to unpack, from strategy to your journey. And I want to start off just building a bit of context around your life. And currently, what do you do? What do you get up to when somebody says they're a hedge fund manager or managing other people's money? What does that look like? What does that mean?
So yeah, I basically manage funds for clients. And my job is to basically make money for my clients. And it's a journey that I chose. I wanted to take a professional route. And that's been my sole focus. And I basically wake up, answer some emails, communicate with my team, and I just basically try to complete my task that I have to do for the day, and of course run my fund initially.
Your journey initially was very similar to a lot of people watching, very similar to my journey, which is you try it out online. You're a university student, you're trying to learn things from the internet, personal account. We'll touch upon the loan situation that you mentioned off camera, but eventually you took the investor route and a professional route. I want to understand, what is the reality of the difference between somebody managing their own money versus someone managing other people's money, and more the upside for you, like financially, but also the headache, the logistics, the execution of trades, the strategies you could use. Is there a lot of differences, or is just trading like your personal accounts but for other people?
Yeah, I think obviously having personal accounts is good. You don't have the stress and the pressure that comes with managing money for other people. But the downside is that you might be limited by capital. You might not have enough capital. With investors, you have access to larger capital. Of course, there is pressures involved in it. But if you know what you're doing and you basically believe in your strategy and in your systems, then you can, of course, scale your capital. And that's the goal. Initially, me personally, I don't come from a very wealthy background, so I never had access to big capital. So for me, it made sense that I had to perfect my skills and create systems that could help me eventually build my confidence and then go ahead and actually acquire capital from investors. Because when I started was around 7 years ago, I did not have solutions like the prop firm solutions, etc. I had to use my own capital, or at least find investors to trade larger capital.
Now, when you first started out, which was a very normal route, was it always the goal to get into a professional situation like this, or it came about?
It came about. It was never planned because I actually studied architecture. So I never had a background in finance. I didn't know what trading was initially. But once I got into the industry and I started trading my personal account, which was a small £500 account, deposited into IC markets. And of course, then there was a lot of noise around trading signals back then. So I was getting the wrong ideas, if anything, and quickly realized that it was not working. And then I had to dive deeper to understand that what was not working. Then I started to do research and understand the reality of trading, how the professionals are trading, how the retail markets are trading, understood the differences, and that's when I kind of clicked for me that I need to go the other way, the more institutional way. And that's when I kind of planned my journey that I will focus more on that side and build myself up to a point where I can actually have my own fund, have investors, and trade that way.
The day you had the idea of, I want to take a professional route with other people's money, what was that time period between your own accounts, your own funds, and your own trading to actually be ready to take on other people's money? Is that a long and difficult process?
My process was actually very simple. So once I started becoming profitable with my trading, and I basically, well, actually, the story is that when I told my dad that I wanted to trade, he knew a friend that was actually, his son was actually working in a corporate trading floor. And that's when my dad actually introduced me to him, and we sat down and we spoke a lot. Okay. And that's when when I kind of understood the two differences between institution world and the retail space. And when I was being profitable, then I was like, okay, I want to go that way. What can I do to basically enter that industry? And he was the one that kind of basically helped me out on giving me the steps on what I need to do and how I can get my foot inside the institutional world. But yeah, it was a long process. You know, it was not like a switch. I had to basically do many things, many steps in order to become a trader that could even be accepted in the institutional world.
Right. And I guess that brings us onto your journey with the University of Geneva and going through an investment banking degree?
Yeah, that's correct. So I basically then did a program from University of Geneva, investment banking. Once I have done that, then I basically, my friend who was working in a corporate trading floor, he invited me to do another program at his corporate trading floor, which I completed as well, which was also an investment banking program. And yeah, that's how I was gaining my credibility. And then the biggest factor was, of course, to authenticate and audit my portfolio. Mm-hmm. So these were the 3 steps that I had to basically take in order for me to take the step and go into the institutional world.
As your background was architecture and you didn't have traditional finance foundation, was jumping to a degree level in investment banking quite difficult?
Yes and no. Obviously, it was a brand new world for me. I had to learn a lot, like the terminologies, mm-hmm. etc. I mean, there was a lot going on, charting, research, news events, etc. So I had to learn quite a lot. But I was dedicated. I wanted to do this. And I mean, for me, if I put my mind to something, then I will obviously give my 100% and try to, understand what, all the topics and try to learn the whole process. So eventually I got there.
Was there anything important that you felt like you picked up from this degree, apart from just general knowledge, that somebody watching in their trading career could find benefits from, whether it's strategy, charting, or something like that?
With the program, what I've learned is that everything has systems in place. Everything is done by the paper. You basically need to have systems and progresses in play. And I would say everything is a lot more research-based. So whereas the retail side is more technical-based, I feel like the institution side is more research-based. They focus more on creating case studies on each trade idea. So that basically means that they will, let's say, use a trade idea and build a whole case study around it, look at fundamentals, news, do some research, and then they go ahead and basically decide the risk, how much they will risk on this specific case study, and how they will diversify everything. So there is a lot more research that goes into one trade case study, mm-hmm. instead of just doing a technical analysis on a chart, right. and then maybe looking at, for example, Forex Factory, and then, taking a trade.
With that level of due diligence and building a whole case study, I assume it's more for a swing or a longer term play. What about the risk side? Would they, because they're putting a lot of effort and team involved in creating an idea, how do they approach risk, or how would you approach risk in your own fund?
So me personally, we have different categories for trade setups. So we have AAA setups, AA setups, B grade setups, and each category has a level of confirmations. So the AAA would be a more premium case study. That means we will most likely risk a little bit higher on that specific category. And then the lower it comes, the lower the risk becomes as well.
Got it. What would just let's say some bullet points? What would categorize an AAA setup for you?
So there will be specific confirmations that we look for. Before I even maybe explain the different categories, it might be wise to explain how my fund actually is structured.
Sure.
So that way it makes more sense, because we usually have a methodology behind our fund, a philosophy, let's say. And my philosophy is very simple, because I looked at, let's say, the most sophisticated index in the world, the S&P 500, and why it's been so consistent over the years. And initially it's the top 500 companies, right, in the US who are performing. And the reason why it's so successful is because we can look at each company as one strategy, right? Each company, they're basically progressing, making profit. For example, last year, 2024, only the top 7 companies made 50% of the profit for the annual. Wow. And the top 10 made around 74%. Okay. So just a very minority of companies actually made up the whole annual profit for that year. And that goes to show that when you have multiple strategies, you can actually diverse your risk. And even if one, let's say, strategy is not working, maybe the other strategy will basically overpower and get your portfolio in the greens. And that's my approach as well in the fund. So we have basically multiple strategies, multiple portfolios, and that's because we are trying to diversify the risk. So when we are trading, we're looking at, for example, one portfolio, which is our main portfolio, that we take only AAA setups. Mm-hmm. In our secondary portfolio, we only take AA setups. So we have different allocations for different setups, and that's how we kind of basically run our fund.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry, and in the last year they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
So there's multiple strategies and multiple accounts and multiple trade grades.
Yes.
And logistically, is everything going through you?
Yeah.
Oh, it is. When it comes to, let's say, idea generation, because you have all these accounts and all these things to consider, and I don't even know how many asset classes you may be looking at, how many people does it require to have a sufficient infrastructure?
So my team is around 7 people. So we have a 7-person team in my fund, and each person has basically different roles. And we have basically 2 analysts who are trading 2 different strategies. And those 2 analysts actually have another secondary strategy as well, which is a bit more systematic. And what we do is we basically have to go through processes. So for example, if we're trying to build a case study, we will look at, let's say, a trade idea. The trade idea goes to, for example, the research team, and the research team will actually research on that asset class, for example, news, research, any fundamentals, and create a report on that instrument. Okay. Once we have the instrument, then that goes to the analyst, and he will basically look at what is written on the report, and he will basically see if the technical aligns with the research report. Mm-hmm. If those 2 aligns, that's a good sign usually for us. Once that's done, then it goes to the risk team. And the risk team will then basically go ahead. So we have basically key requirements for trade ideas, and then he will allocate a certain risk on that report and allocate if that trade idea is a AAA setup, AA, or a B grade setup. Once that's done, then the report comes to me, and then I basically overlook the whole case study. And if I see if it's a good idea, if it gets approved or not, once it's approved, then it goes to the execution team, which executes the trade.
This is very interesting. And something that is very commonly known is when it comes to, let's say, prop firm trading, the traders that blow their accounts is not because they reach the minus 10% or the drawdown limit. Usually, most accounts are blown from the daily limits. The reason I bring this up is because risk and people's emotions, when they're really sworn to an idea and they've spent time creating a case study, they can spiral in a single day and mess it all up. what is the reasons behind dividing risk from the guy who's making the idea and generating the trade versus the technical guy and then also the risk guy? Why are they split up as opposed to the decision maybe all on one person?
This is something that I have learned from the institutions, from the trading floors when I was around. And I've seen that they have departments for each different responsibility. So there's multiple people working in a specific department, and their responsibility is to just handle that specific task. And it makes sense at the end of the day, because we as retail traders try to do everything ourselves. We try to do the research. We try to do the technical analysis. We try to do the risk ourselves. And there is a lot of emotions involved. And I feel like it's better that if you focus on one thing and you just master that. And that was the whole idea. And I feel like I wanted to do the same thing in my fund. I wanted to have someone who looks at risk. His main job is to understand risk, allocate risk, understand when to scale in, understand when to exit positions, understand when basically like the trajectory of risk on what's the best outcome that we can have, or maybe all the different parameters when it comes to risk. So his job is to manage the risk, research the risk, allocate the risk, and make sure that we are possibly putting in the best risk scenario that we can get out of the trade idea.
When it comes to risk as a topic as a whole, what kind of variables can you have apart from just say position size? Is there also risk of scaling in, scaling out, when to go break even? What other moving parts are there to have also a dedicated person to let's say make judgment and actually make decisions?
Yeah, like you said, we have variations like breaking even, trailing or stops, scaling in, scaling out, maybe even invalidating ideas. And these are certain things that we look at. And we also look at the market move. So we look at the volume that's being injected so we can understand if market has some push to the case study or not. And his job is also to basically monitor if maybe, for example, there is a news event coming out. Do we need to get out of the position?
Okay.
Do we stay in the position? Do we just put our stops to break even? So there are a lot of variations. That's his job that he needs to kind of research and understand and take the decision.
And the person who is involved with the risk decision making, what is his particular skill? Is he also a trader, or is he more in the mathematics probability? What makes a good risk operator, let's say?
So someone who basically is good with risk is obviously he needs to be a trader to understand. And there is also actually a program that you can do. It's called FRM. It's basically a specific program to understand risk.
Really?
And
Okay,
that's something that we made him do that as well. So just to basically train him. And of course, I train him as well myself to make sure that this is what I want from my fund. These are the requirements, you know, all the parameters and et cetera, et cetera.
On a fund level, the typical comments I hear is like the investor is already rich. They're not trying to make 1,000%. They are more concerned with not losing their money and I guess going for the normal beat the markets 5, 10, 20% return. With that, is that also your approach in terms of annualized gains? What would be a target you would have?
So me personally, I try to aim for 2 to 3% a month.
Okay.
So around 27 annually. And obviously we want to beat the S&P 500, which is technically the benchmark.
Yes.
And we want to outperform it. And yeah, there are wealthy clients, but they still want to make a profit at the end of the day. And that's our responsibility. And we have to make sure that we are performing and we are delivering what we have basically promised to our clients.
I think the key here is that when you're going for 1, 2, 3% per month, this is a very accepted amount. But when we do, I want to bring the parallel of prop firms in. The minimum is, let's say, 10% to pass or 8% to pass, which skews things and therefore leads to more aggressive risk and so forth. With the goal being 1, 2, 3% per month, across how many trades is that usually per month? What's the average trade duration? And what's the kind of risk per trade? I guess it is a variable, but what would be the lower and higher end of the spectrum?
So it depends, to be honest. We could actually take only 2-3 trades in a month and stay low risk, or it can also go to 4-5 trades a month. It just kind of depends on the market condition. There is no set rule that we have to take this amount of trades or we have to take minimum this amount of trade. at the end of the day, if I don't find any case studies, then I will stay cash and I will not execute any trades. And I think that's very important. I feel like a lot of traders in the retail market are so focused on taking a trade. They feel like they need to take something. If there is 1 week they don't take any trades, it's the itch is building up and they feel like they need to force a trade. I'm more than happy to sit 3 weeks without a trade.
Yes.
It's not a problem at all. So it just depends on the market condition and what the market is willing to give me.
And somebody asked me just yesterday, he was basically saying that he heard online that certain traders make the majority of their money in the year in a small window of a couple of months, and the rest of the year might be losing or just sitting on cash. And he was basically asking me, like, how have I navigated that? Or is that something I experienced? My response was not really. And I think the reason for that is because I'm focusing on a purely technical edge and I'm more intraday, intra-session orientated. So the movements of a euro dollar year round during an intra-session, during a London window is going to be pretty stable. You're not going to have certain London sessions in August that are massive.
Yeah.
Whereas in your realm, it may be different. Do you find that seasonality comes into, or certain periods of the year are more appropriate for your strategies, and therefore the annualized return is usually skewed towards a few months?
Not dramatically, I would say. There are basically conditions where our strategy might struggle. For example, usually based on our historical data, we can see that towards Q4, towards the end, we have a bit of a slow performing month. For example, December, January is usually quite slow for us. But overall, we are quite stable based on our strategies, and we don't have, let's say, a few months of profitability and the rest of the season we stay not being profitable. So in that regards, I feel like we have something that is working, and of course it can always change, but we're always adapting. So if there is some changes in the market cycle, we like to look back and see what are the changes being caused. For example, I remember in 2024 or 23, I forgot, towards the end of Q4, we were having a couple of bad trades, and the strategy stayed the same, but we had to look back and see what was causing us to lose these trades. And we understood that the market was actually pulling back a little bit deeper. So that kind of made us adjust the stop sizing and stop placement on that specific scenario, and that kind of fixed the problem. So we just had to look back, see what the market condition was doing, and then make some adjustment towards our strategy. But obviously market cycles is a thing, it does happen. But as long as you adapt to it, you can always overcome it.
I think that's why you probably have the multiple strategies to factor for trending, non-trending markets and so forth. I want to also, just personal curiosity, when you take on the route that you have, which is you had to get certain degrees, you had to also get certain audits, you had to probably prepare a track record in a certain way to be presentable. And now your life is managing team, dealing with investors, pressure, headaches, like all of this extra work, which is what I see from the outside. What is the realities of the benefits of taking this route that somebody may be thinking, what's the point? I can just max allocate with 10 prop firms and have a few $1 million and go from there. What is the appeal to take this route?
Well, I think obviously prop firms is a good thing, but it's quite uncertain. I have a lot of friends who are from the prop firm space, and they're always telling me about my payout got rejected, some prop firm went down, I lost my capital. I mean, there is so many things that can go wrong, especially if it's not regulated. And especially me, when I started, prop firms was not a thing. So I never really started when prop firms were rising. So I had to find a way where I can increase my capital, because I never had big capital. So I had to find a way with investors, and that's the way I went. And now, especially with prop firms as well, I'm still happy with my way. It's not like I feel like I'm missing out and I should go that way. I feel like doing something professionally that's been around for a very long time, and it's, there is a lot of certificates involved, and credibility is there and regulations is there. I feel like it's a stable market, and if you do it correctly, you can stay in this game for a longer time. And my goal is to just keep building this fund and grow and expand. And just stay in this route, and who knows what the future may hold. If I might even transition into something else, God knows.
I think it's very cool, because with the prop firm space, I think it solves a young person's problem of, I just want to make a few $100,000, and prop firms can cater towards that, because you can get $2-3 million in funding. But if you want to start hitting $10, $50, $100 million, the only way is a fund, and
Yeah.
bar no other option. With your own fund, I don't know what kind of things you do disclose or want to mention, but what kind of goals do you have in terms of for your own personal finances and also just AUM and maybe other endeavors?
So yeah, my fund is in the early 8 figures now. So we're managing a decent amount of fund, and my goal is to grow it, but I am not in a rush to grow it quite quickly. Because I feel like if you try to do things quite quickly, it can go wrong quickly. Especially my team is also quite small. I feel like for the level I am at right now, with a team of 7, managing that amount is all right. It's perfect. But I also understand if I want to increase my capital in my fund, I will most likely have to expand my team as well. So I do have plans for this year to expand and take on more investors. But for the time being, I'm just holding back, making sure my structure is solid. I have a strong infrastructure. And then, of course, I need to find some traders or other people who want to join my team, and I need to train them to make sure that they're fit in the fund. So that's something I also need to consider before I actually open my doors to taking on more investors.
Sure. Did this capital that you have at this date, did it slowly increment, or do you occasionally get a big deposit and therefore a big jump? And does that feel scary that you've got an extra, 7 figures in the account, and therefore extra pressure and so forth? Even at your stage, do you feel the numbers?
Yeah, you do feel the numbers. It's kind of surreal in a way, and managing that type of capital is stressful. And I think I even told Riz I'm 28 years old and I have so many gray hairs, and it's crazy. And but at the end of the day, if you want to achieve good things, you need to, go through these hardships and difficult times in order to see the greater things. And I feel like I am ready to actually take that stress on board and try to give my family a good life, try to give myself a good life, and hopefully maybe start this generational finance fund that I can maybe carry on,
When it comes to, you said when you get more, or if you do get more capital, it requires a bigger team. Let's say a fund that is at 50 million or 100 million, that's when I'm seeing that's serious numbers. What kind of a team is behind that? Because when you said 7, I don't know why I just felt like, oh, that's not a huge team. I didn't know the capital you had behind it, but that's quite a lean team, because there is also compliance. There's a lot of things you have to consider. But when you do hit 50 or 100, can it still be a lean team of, let's say, 10, 11?
It depends on your license. For example, if you do a white label license, then you have a lot of the compliance being taken care of.
Right.
So, but if you are, let's say, not opting for a white label license and you're doing a full license, then you will need to get in-house compliance, lawyers, accountants, etc. So then your team will grow quite dramatically. The cost will go up as well. So it just kind of depends on what licensing you're going for. But for a fund size with 50 million, you will definitely need more traders, more risk team, more research team. So there is a big jump to it.
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
Does the guys in your team who are generating the trade idea from technical and also fundamental, are they aware of the final risk that goes on the trade? And are they aware of the account size at all, or do you protect them from that?
No, they do have an idea. So they do understand what they're dealing with, but they're, like I said, it's they have a specific responsibility. So they don't need to worry about calculating the risk or understanding the risk that goes behind the case study, or doing the research on the fundamental side or the economical side. Their job is to just analyze, create the reports, create basically the case study, and just focus on that. And then they also, the fact that they understand that this case study goes further, and then there is someone else that works on top of that, it gives them the peace of mind that they're not the only one just making that decision. It's a collaboration of a few people together.
I think that does help when it goes wrong, that it's not all on one person's shoulder, and then they mess it up for the next trades. You can kind of feel it as a team. How does it go with comparing? You said you wouldn't change your journey looking back. You like the route that you took. But for people watching that, maybe are saying, okay, that's a very cool option. I might consider that. What is the tipping point where it's worthwhile? And what I mean by that is when you have a prop firm route, $1 million, $2 million in allocation is doable. I think beyond that, it does get a bit tricky with firms going down and denied payouts and all these things. But I think comfortable is 2 million. But you do get 90% of the profit split. Whereas in your situation, I would imagine majority of the profit goes towards the investor, and obviously you have a management fee. What is, let's say, the minimum amount of capital somebody would need for it to be like, okay, anything above this is better than the prop firm? But if you only have a fund with 500k, maybe prop firm is a better route.
So I'm not sure about the ins and outs with the prop firm side, to be honest. So I don't know how exactly that works. Like you said, 90% profit split, and obviously there is the risk of things going wrong whatsoever. But obviously with the institutional way, it's a bit different. You have a management fee that you take. If you, let's say, make a profit, it's guaranteed that you will get paid out because contracts are involved. So you don't have to worry about, am I going to get paid or not, etc. Yes, majority of the profit goes to the investor. But when your capital is healthy, even your split is a healthy balance. So it's not like, oh, I mean, I'm not getting too much. It's a healthy amount that you can live comfortably with. So in terms of how much is the tipping point where you should consider going the institutional way, it depends, to be honest, because let's say if you have 2 million with prop firms and you're making decent amount of money, and then you don't have the stress of investors being over the top of your head, then I think you should stick with prop firms as long as you can get your cash flow coming in and you don't have any rejections in payout. I think it's a good way to stick there. But let's say if you want to go to 10 million, I feel like prop firms would be a bit of a tricky situation. I don't think you can quite scale that. Then maybe you should consider going into the institutional world. I always tell my friends as well, I say, look, trade your prop firms. You can always trade your prop firms, but why don't you also try to create a track record so you can eventually get some investors on board as well? Why not do both things? Because at the end of the day, you have to trade, you have a strategy, you can apply them on both sides. But it's always good to have two options, because if one goes down, you always have your backup. With prop firms, we don't know what's going to happen. I don't know if regulations will come in, if this is a bubble or not. But if it is, then you need to be prepared, because if, let's say, there was a time, I think, when the American traders were they
for regulatory reasons they couldn't only futures, they couldn't trade forex prop firms.
Exactly. So like for situations like that, it's good to have some backup.
Yes.
And in order to have a backup, you need to create a track record. So maybe work on a track record, have it. Maybe don't go that way, but at least have a track record. Worst comes to worst, you can always go that side.
I really like that advice. I want to understand it better. So when somebody may hear track record, they might take it from the lens of prop firms and think, oh, I got to get a 50% or 100% a year. Otherwise, it's not worth anything. Probably because it's going to be a smaller account too if it's self-funded. What is an appropriate track record in terms of deposits and annualized gains?
Okay, so a decent track record would be a stable, boring track record, first of all. So first thing to understand is that I know in prop firms you have to make 10% a month. And if you don't make 10%, then you fail the challenge, I think.
Different rules, but more or less, yes.
Yeah, so and that's a quite toxic mindset, in my opinion, because I met a lot of guys who were trying to pass challenges and they couldn't make 10%, and they were only doing 3-5%, and they thought they were a bad trader. Yep. But in my eyes, that was actually that's a good return in the institutional world. So just because you can't make, let's say, 10%, that does not mean that you're a bad trader. But in the institutional world, you need to make 2 to 3% every month. And another important factor to consider is that when you're making your track record, don't have it in wild graphs, meaning that 1 month you're making 7%, then you're down 4%, then you're maybe up 14%. It's it's too wild. You want to have it quite boring in a way. So 2%, 3%, -1%, 3%. So it's a very small range that you want to have. Do that for a whole year. Once you do that, then you basically get your track record audited. Now, a lot of people just put it on my FX book. That's not the way forward with the institutional way. But what you need to do is you need to get it audited by a big accountancy firm. Now, one tip I can give you is, for example, KPMG. They do they audit accounts as well. And when you are trying to get investors and they see that your track record is audited by KPMG, that adds a lot of credibility to your name, because KPMG is the second biggest accountancy firm in the world. So you need to try to put as many credibilities behind you, so that way it's easier for you to win the trust of your investors.
Was that the plan with the degree as well that you
Yeah.
took? It was for the trust factor.
Yes.
With regards to the track record building phase, what is an appropriate duration? Can it just be 6 months, or would it have to be years, multi-years?
I would, for a track record, I feel like 1 year at least minimum that you need to do. And
do they care about the balance? Like if you deposit 10K with that?
Obviously, the balance does matter. If you can have a higher balance, it will help you. But as long as you can have a smaller balance, but you can show consistent returns, that will get the job done as well. Obviously, it depends on the investor as well. And if they feel like, they're happy with your results, even though it's a smaller balance, then they might even give you a tester. For example, they'll give you a small allocation of capital.
Right.
And then if you can perform on that, then they will eventually inject more capital. So it can work, yes. And if you can do a bigger capital, then it's even better.
The year that you were building your track record, how was that experience? Because now it's a different way you trade, and it's through teams. But back then it was just you, and I guess the normal problems that we all face, what you also facing. So what were those days like?
Yeah, it was a lonely journey. It was quite hard. I had to. I remember I went through so many phases. I wanted to quit at some point, and then I looked back and I was like, if I don't do this, what else am I going to do? I might have to go back to my job. So I didn't want to do that, because I was working in an architecture firm and it was not for me. So I always reminded myself of that, and I was like, okay, no, I need to make this work. And there was a lot of hardships. There was a lot of hard times, but I kind of locked myself in and gave it all, to be honest. For me, it was like, there is no other way. I have to do this, and whatever it takes, I'll do it.
What was your, if you can, let's say, categorize it, what was your trading style or strategy back then as an individual retail trader?
So back then I was looking at key levels, and I was trying to trade off those key levels. I was using a lot of volume as well. I was looking at where volume was injected in prices in specific key regions, and I was trying to combine this with news events, and that's how I kind of started it. And then my strategy kind of basically developed further, and then it became a little bit more complex. Then we started using some ATR, etc. We were using heat maps.
Okay.
And
you were not trading Forex. What were you trading? What asset class?
Forex.
I was.
Yeah.
How were you accessing volume and these kind of things in the Forex market? What was your way of reading it?
So we use a charting platform called Sierra. I'm not sure if you are aware of. Yeah. So we use that. We also, TradingView has some tools as well that kind of shows you the volume, etc. You can look at the ATR. There were some tools that we were looking at. Well, I was looking at myself, and I was trying to figure it out how I can put everything together and make a strategy. It was a gradual process where I had to kind of adapt as I was going until I made my complete setup. And it was a long journey. It was a lot of trial and error where I had to basically test a lot of things out. I was collecting so much data on everything I was doing as well, because when I spoke to my friend who was working in the trading floor, he said that everything is about data. So whatever you do, collect data so you can conclude your data at the end of the day. So I used to basically trade, and I used to collect data up to a couple of months and then look back at the data and see what was working and what was not working. For example, I was understanding that, London session was not so good for me. So then I started to remove the London session out of my trading plan. And then I also understand what currency was working best for me, what currency was not working the best for me. So there was a lot of things I had to basically take away, add, etc., based on the data, and then trying to make my strategy, my plan as bulletproof as possible.
And when it was building your tracker record, I'm more interested because I think that's more relatable for people watching. Key levels. Can you help me understand what you mean by key levels?
Yeah. So what I look at is basically heat maps, and the heat maps basically indicate where price is basically stagnant or there is a lot of volume being injected. So when we look at these heat maps, it's basically a buffer of zones, and then we narrow it down to the nearest 50 or 100 as a psychological level, and that level has a lot of significance. So we understand that price will go into that region, and it will basically stay in that zone for a while until some volume will kick in and price will start taking off to the next key level. And that's something that we look at, and we basically try to wait for price to get into that zone. We don't take trades in that specific zone because that's where the war is initially happening, where price will decide in what direction it wants to go. A lot of people try to catch the tops and the bottoms. I feel like that's a difficult task. I like to wait when the market has showed its hand and it starts moving. Once it starts moving from major key level, then there is a smooth space for price to basically travel. And that space is where I like to basically execute my trades.
Does this therefore indicate you're more of a swing trader, even back then?
Yeah, more of a trend trader, I would say. I'm not a reversal trader, I would say. We like to focus on trends because it's easier to catch a trend if you know what market the direction is going to. And I feel like catching reversals is more of a guessing game, and it's a lot more difficult as well, personally.
I'm in agreement with you. When it comes to directional bias, there's many ways somebody can pick it. And the key level, kind of seeing it arrives to a key level, is accumulating, distributing, what kind of rejection to assume or see. Is it a new trend or is it a reversal? What's going on here? But longer term sentiment, how are you building that? Is it just technicals, long-term trend, or is it more fundamental based, as you may be doing more so now?
Yeah, fundamental based. We try to build a case study and see where price is going. We also like to implement a lot of reports from other institutions like JP Morgan, Deutsche Bank, Citibank, etc. See what they're referring, what their stance is on different asset classes, etc. And then we like to basically see if it matches or bias as well. And if it does, then it kind of also gives us a confirmation, because at the end of the day, you also need to understand that 70% of the market is being moved by these big institutions. So if you understand what they're trying to do and you understand their mind frame, you can be on the right way and follow the money.
What would be the best places or resources for someone to find relevant data, certain reports or certain news releases?
On their websites, you can they have public reports that you can access, and this is something that you can go and check it out, read their reports, and try to understand that what their stance is on the markets.
Would it be in real time, or is it after a bit of a lag when they've already...
Yeah, I mean, they usually give a forecast maybe for the quarter or for next couple of months, or maybe they basically don't have it like for the day or something, but it's more of a for the quarter, let's say, that what they're trying to decide where the market is heading.
Why do they give this information out?
It's a good question. I'm not sure why, but it helps. And
it helps average person, but it doesn't serve them in any way. Unless it's some sort of regulatory or for their investors to feel comfortable, maybe. But okay, interesting. So it seems like a bit of a loophole that you can see what the big players are doing.
Yeah.
And it might even be a self-fulfilling prophecy, where if they're the ones that are 70% of the market movements is coming from these participants and they're disclosing what they do, then what they do will happen because they're the ones with the volume. So it is pretty interesting. How about taking a trade idea, whether it's your key levels or fundamentally driven? How do you generate idea and case study to actually an execution? What is that final thing of like, my entry is here, my stop loss is here? Is that going to be through technicals and intraday analysis?
Yeah, for entries and stops, etc., we look at the technical analysis, try to look at the charts, etc. We don't have basically take profits. We don't have set take profits. We basically see where the market is heading and use the structure of the market to decide where we want to exit the position. With the stops, we like to calculate the ATR to put the stop in a safe place where the price is unlikely to get there based on the volume.
Yes.
And that's how we basically plan out our entry, stops, and take profits.
do you have predetermined exit points when you forecast the trade, or do you kind of see exhaustion at the next key level and kind of trail your position?
We like to see what the market is doing, so go with the flow, because at the end of the day we don't like to pre-decide let's say a take profit, because in that sense it's kind of imaginary. If you're, let's just say, putting that's where my target is and the market is not even there, you don't even know if the market will push up to that level. So you have to see how much energy and essentially the market has, and if it's pushing and if it has enough volume for price to go up further. And if, let's say, price is slowing down and volume is dying out, then we would like to maybe take our stops to break even or even exit the position. Depending on the situation, we just like to see what the market is doing and then make a decision based on that.
So the crypto bull market is well upon us, and with opportunities left, right and center, why not utilize other people's money instead of your hard-earned money? So introducing to you the world's first crypto prop firm, Bitfunded. And they've partnered up with an exchange to bring not only the world's first crypto prop firm, but actually a prop firm that has an exchange-like environment. Imagine as if you're trading on Binance, with all the benefits that prop firms bring, with the leverage you can have, or hundreds of thousands of dollars in buying power, utilizing other people's money. So your total risk is just a couple $100 max, or as cheap as $79. And with the special offer that they have going on right now for you as a Titans of Tomorrow viewer, if you buy 2 prop firm accounts, you'll get a third one for free. So click the link below this video to head over to the Bitfunded website and start to utilize other people's money to benefit from the crypto markets whilst minimizing your downside.
You mentioned quite a few times, let's say, data, probability, volume. And what I'm kind of reading between the lines here is that you can have technicals and certain zones, let's say, but it's not necessarily the most relevant thing. And what I'm getting at here is when I decide to take profits, I'm usually doing it on an average daily range. I'm an intraday, intra-session trader, so I can hope that price goes and makes a new high. I can hope all these things, but if the average movement on a day is 50 pips, why should I have a profit target after that? Unless it's a swing play, let's say. But in that sense, I just go with averages. What kind of tools or indicators or averages are you looking at? Would it be down to as little as what I'm doing as a daily range, or what is your trading ranges of data that you
So
consider?
this is, for example, something that my risk team does as well, is to understand, let's say, whatever instrument we're trading, we have to understand that what is the daily or let's say the weekly range that price can move up to. And this is something that we have to look up as well. And it's a very key point that there is no point trying to place a target that's way above the daily
Average
range, for example.
Yep.
And when people do that, it's kind of silly, because you're setting targets that are unrealistic, and you need to be realistic with your trading, and you need to basically place targets where price can easily reach. I feel like a lot of people try to make it harder for themselves instead of making it easier. And our goal is to basically keep everything simple. Even if, let's say, the market gives us maybe, let's say, a return of 1%, we'll take it. If we see the price is now dying out and price has no more volume to push further, it's okay. We take the profit out of the table and then we'll revisit back, or maybe look for another case study. And that's something that we do, because my thinking is that the longer you stay into the market, the more you're exposed to the market, and the market taking your capital in a way.
I was reading the book Market Wizards just a few weeks ago. I forgot who the trader that was the case study, but he was basically saying the further away your take profit level is in time or in distance, the less probable it is. And it might sound a bit counterintuitive, because swing traders have their edge built in with distance, with, I guess, macros, interest rates and inflation have these impacts on an economy. But the simple way he put it was like, if I am to put a gun to someone's head and say, where is the price of $1 going to be in 5 minutes time? You can be 99% sure it's going to be within a small box of 20 bips, plus or minus.
Yeah.
But if you say, okay, where's it going to be in 3 years? Well, it could be all the way up there, it could be all the way down here. And it was an extreme example to basically say that probabilities decay with as more time goes on. With all of this being said, because you're speaking my language, are you, or would you recommend, or is this something normal to kind of scalp intraday trade on a fund level where there's way more capital on the line?
It's possible. There are basically portfolios specifically designed for scalping. There are funds who use algos as well. So these are things that is being used as well. I mean, I have a portfolio for intraday as well.
Okay.
We do have one, and we have also a swing portfolio as well. But yeah, it's possible. I mean, you'd be surprised that there is so many funds doing crazy stuff. I was reading one day that there is a specific fund who only focus on swan events. So
Oh,
their
yeah.
only job is to trade swan events, and that's what they prepare for.
Interesting.
So yeah,
You know, they say it's a black swan event, but when you look back in recent times, every year there's been something, whether it's
Exactly.
a war, whether it's a COVID, whether it's a, like there's always some election, this, that. There's always something that is keeping the market hot. So
100%.
I guess it can make a strategy. Do you have any, let's say, role models? And what I mean by this is, I'm sure you have many, but what I'm specifically referring to is people may be watching the show. Natural role models will fall to the influences that they consume the content of, and the lifestyle they may show, and the things they teach, and the philosophies they have. Usually people easily embody them. Whereas you've kind of probably seen all of that in your years in the space, and you are also in a different game, which is the institutional way. Is it normal to look up to the Medallion Fund, Ray Dalio or Warren Buffett, or is that not necessarily the gold standard for you?
I wouldn't consider them as my role models, but definitely someone I would look up to because they have done so well in life, and they obviously have done the correct steps to get in that position. So these are people I like to read on, basically read their books, or let's say if they release a video. I think Ray Dalio did a fantastic video on the cycles of the markets, and I always like to just understand and see what they're thinking and what basically their mindset is like, because in order to get to a certain level that they're at, you need to be operating in a different level, I believe, because I feel like where I was before and where I am now, there is a major difference, and I feel like if I go further, I need to be in a completely different headspace. So just to get a little bit of insight, I like to look at them and see how they're operating, what they're thinking, how are they talking, how are they making their decisions, what are the moves that they are making. But coming up, I actually used to look at Anton Creel. I don't know if you know.
Yes, I've seen his stuff.
When I was trying to get into the institutional space, I used to listen to his
The
university
lectures, yes.
lectures, etc. But those were quite actually insightful as well. So, but other than that, I can't really think of anyone else. But I'm sure there are people that I looked up to and try to learn from. And because for me, when I was coming up, I was a sponge. I wanted to learn as much as possible, and I was open to listen to people who are doing better than me and try to learn if I can maybe pick something from them and try to put it in my own, my own basically journey.
There's maybe a controversial question, but I'll ask it anyway. I recently saw a Mark Zuckerberg interview, and they asked him, like, what is your number one thing you look for when you hire someone? And he actually gave overly simplified answer, which is like, I optimize for IQ. I just look for high IQ people, because they'll learn the rest. They'll figure the rest out. As long as they have high IQ, can solve problems. And when I did recently a deep dive on Jim Simmons and his whole medallion story. And it is a crazy story that I didn't realize, and I think it's cool for everyone to look into. But his whole philosophy was basically finding the top talent. In fact, he had his own incubator, I think, of the best mathematicians in the world. And they weren't even traders, they were just mathematicians, and they built AI, and they carved out an edge through just sheer intellect, it seems like, and powered by AI. Do you think to find success in the markets, IQ plays a part?
Look, I would say I'm not the smartest man in this room, maybe, but all I know is I'm very disciplined. And I always like to say that if I did it, you can do it too, to anyone watching. And I don't think you need to be the smartest person. I don't think you need to have a crazy IQ. I've actually met a lot of people who are not the brightest, but they do very well in life. And that shows me that sometimes all you need is discipline. And you need to know what you want to do in life, and you need to be disciplined enough to stick to it and take responsibility to get where you want to. So yes, maybe IQ helps. I feel like obviously if you're a bright person, it will definitely help you. It makes things easier. But I have met people who aren't the brightest, but they are doing very, very well.
What I've found is the smartest of people, just people I've interacted with in my life, and even the Jim Simmons Medallion Fund story, the smartest minds he had all were academics. So
Yeah.
they really found joy in just the pursuit of knowledge and research and whatever. And they couldn't care less about money and entrepreneurial endeavors. So he really had to convince them to actually take the route. And when I look at certain people that do really well in life, especially in this city, it's not the smartest people. The smartest people end up being CEO, CFO, and serving someone else's dream. But I think you have to be not an overthinker. And I think a lot of high IQ people just end up thinking and don't bet on themselves or don't take a risk.
100%. I think there is a very famous saying, I don't know how it exactly goes, but it says something like, a fool with a plan will beat a genius without a plan. And as long as you're prepared and you know what you're doing and you are disciplined enough, you can definitely succeed. And I think, like you said, a lot of book smart people get into high positions, but I've seen a lot of people who may not be the smartest, but they have businesses, they have these successful, basically, entrepreneurial journeys, etc. So I feel like you don't need to be the smartest to succeed, but obviously you need to have certain points in your character that is essential in order to succeed.
With the fund portfolio that you have, how do you divide? I'm more curious because I always thought, a misconception maybe of mine, that intraday scalp trading is kind of frowned upon because maybe the professional investors see it as kind of noise or risk, and the lot sizes, the actual execution of a trade, when you have certain multi-7, multi-8 figures, to place an appropriate risk, or even if it's a 1% risk, on such a large balance, you may have execution or issues or so forth. Logistically, how possible or how much potential is there in, let's say, a scalp intra-session approach?
Yeah, it depends. Scalping is not in my portfolio, so we don't really scalp. We do have intraday positions on a smaller portfolio. We have then obviously our major portfolio, which is more swing-based, position-based as well. But what you need to do is usually when you get to a certain level, you need to have an LP. And the LP will obviously be much more convenient for you for prices to be executed, etc., instead of a traditional broker.
Yes, because your orders are actually executed. There's no B-book questions. Okay. And I want to lastly just touch upon more certain things that somebody can take home with them. And maybe they could be watching thinking, well, I'm not a fund manager and I don't have all these issues, but certain strategy things that you've had in your years of experience that is something that is applicable to anyone in their trading journey when it comes to fine-tuning a strategy or an approach in the markets when somebody may be feeling a bit lost.
So if you're, for example, feeling lost, you maybe need to go to step one. First of all, you need to understand who you are as a person, I believe, because let's say if you're not a patient person, then swing trading is not for you. You need to understand what type of person you are and base your strategy according to your personality, because a lot of people try to do things and at the end of the day, you are a reflection, right, on the chart. So whatever you are as a person needs to match what you're trading on the charts as well. So try to figure out who you are as a person. Once you understand that, create a strategy based on that. Once you do that, you then have to go ahead and start collecting data as much as possible. And that's very, very important, because your strategy from the get-go won't be maybe profitable, but you need to fine-tune it and adjust it to a point where it becomes profitable. And that's only going to be possible if you have enough data to look at what is basically causing troubles for your strategy. Maybe certain days are not suitable for you. Maybe basically a certain session is not suitable. Maybe you have a favorite currency pair where your win rate is higher. Like, these things are going to play a big factor. So you need to remove the factors that is holding you back. Keep the things that is basically giving you the edge. Once you have that, then you basically stick to that and you basically make sure your risk management is top notch. The biggest strategy that I can give you is risk management. Put a lot of focus on that, because at the end of the day, you can trade whatever strategy you want. I'm sure you trade a different strategy. I trade a different strategy. But if we both know how to manage the risk, we can both become profitable. I can teach the same strategy to two people, and let's say one knows how to manage risk and one doesn't know how to manage risk. The one that knows will be profitable, and the one that doesn't won't be profitable, even though the strategy is completely the same. And I feel like A lot of people like to focus on the strategy and they like to hop on different strategies if one doesn't work, but they don't really focus on managing risk and perfecting that aspect.
So with the life I live, pretty much every single month I'm in multiple countries. So with all that traveling, what that means is I always delay going to the doctor. And you know what happens when you start Googling your symptoms or asking ChatGPT what's wrong with you? It ends up looking like that small bump is 5 types of cancer and then you need to go to the emergency room right away. And I say all of this to say that you don't need to settle, and now the world has changed. You don't need to waste your time or delay things or drive an hour and wait in queues, because when it comes to your health and finding the right professional, ZocDoc has got you covered. ZocDoc is a free app and website where you can compare high quality in-network doctors and click to instantly book your appointments, from mental health to dental health to primary care to even urgent care, where you can find the specialist that you need at a time that suits you and take the call from the comfort of your own home, and even select filters like will they accept your insurance. So stop putting off those doctor appointments and go to ZocDoc.com/Titans to find and instantly book your top rated doctor today. That's ZocDoc.com/Titans, ZocDoc.com/Titans. When it comes to this data collection portion, which is, I think, an essential journey for anyone, how do you decide when a decision is to be made? Let's say the example you said of London session wasn't serving you, so you cut it out. How did you know you're not cutting something out that, let's say you're not cutting out too soon, where you might have decided that it was a choppy market, London session has just been bad for this week, and somebody said, oh, I'm cutting out London session because it's been bad this week, but maybe the next week would have recovered, or a month later would have been different. What kind of a sample size, or how do you make that kind of decision to remove things?
This is what I've basically done. Even before my fund, I already categorized my case study. So meaning that I would have the same strategy, but I was trading that strategy on specific days, only on New York session, etc. And I was categorizing that as my A setup. And then I was still doing, let's say, London session, but I was categorizing that as a B setup. And then I was trading for a while, a couple of months down the line. Once I had a couple of months of data, I would go back and look at both categories and see which one was more profitable. And for me, for example, I still could not make more profits with London session in my trading plan, and I understood that maybe London session is not for me. So you don't just go ahead and completely cut it out. You maybe basically diversify both trading setups, same strategies, but you have 2 different portfolios. And then you keep trading it for a couple of months, and then you see the end results. What are the numbers? What are the performances, etc. If you're performing better, for example, without London session, then you understand that maybe London session is not for you. But you obviously need to trade it, and then you need to test it and collect the data for you to have the answers.
You also mentioned kind of, let's say, people end up on the chase of the shiny objects and just strategy hop. How did you go about that journey to find your own strategy and what is working for you?
Yeah, I basically, the only reason I said that you need to understand who you are is because I made that mistake myself. I was strategy hopping, I was trying scalping, I was trying swing trading, I was trying so many different strategies to a point where nothing was working for me, and I had to take a step back. And that's when I kind of asked myself, okay, what type of person am I? Am I a patient person? Am I more aggressive? Do I like to be in the market for longer? Do I not like being in the market for too long? Once I started answering those questions, and then I started configuring my strategy based on my personality, that's when things were starting to make sense. It didn't become profitable straight away. I started to have a base, a foundation. And from there, I was fine-tuning everything. I was collecting data, cutting off the things that was not working for me, adding the things that was working for me. So it was a gradual process where my strategy became complete. So it was, not working at the start, to finding something, to fine-tuning, collecting data, to eventually becoming profitable.
There's another portion of this trading realm, which is there is active trades you take, which is the positions you may enter on a multiple times a week or multiple times a month. But then there's also the opportunity cost of not taking a trade, because the investor may come to you and say, okay, you didn't take any trades. Okay, you're risk off. Thank you. But I could also just put it in the S&P and got a return. So there's always this battle of you got to beat the market, but you also don't want to get reckless. And there is this opportunity cost here. Is there certain things that maybe an average retail trader can't do, but with larger capital you can do, of just putting it in the bond market, or just doing some things that are uber safe, but it's better than just staying absolutely cash and then inflation is maybe eating away at it?
Yeah, you can't stay cash for too long. Obviously, you have to perform. You have responsibilities that you need to deliver to your client. Of course, you have the freedom to diversify your portfolio the way you want to, the way you believe is the best for the for performance. And at the end of the day, the good thing is we have a lock-in period where the investor can't really take out the capital, so they have to wait after, let's say, 6 months or 1 year before they can even consider to take their capital out, which is decided in a contract. But that allows us to kind of play about. If we don't have any case studies, then we wait, and then maybe down the line we'll find another investment opportunity, etc. So it's the long game. It's not like we are sitting for 1 month or 2 months not taking any trades. There is always opportunities.
Okay.
And it's just waiting for the right one to come and then eventually executing.
Do you dabble into other markets, commodities, maybe even crypto? From an investor perspective, how are those things perceived?
Crypto, not really. I feel like crypto is very volatile, and it's not something that's my expertise, and I prefer to stay away from something that I'm not sure about. And if I don't have any understanding, I'd rather not touch that. And I feel like that's the wise thing to do, especially when you're dealing with large capital. You don't want to make irresponsible decisions and throw your capital on a meme coin and hope for the best.
Are you answerable to every trade to your investor, or they leave that judgment to you, and unless they specifically ask, you don't have to necessarily mention everything?
No, they basically leave it up to me. They trust my systems, and obviously you have to show them your track record and prove yourself, and for them to trust you. And obviously at the end of the day, they're not traders, they're just investors. And they understand that it's my job to basically make decisions and trade the capital, etc. And they also understand that that's my expertise and I have more knowledge compared to them. So they do let me do what I have to do. And that's the good thing about having a handful of investors, not having too many investors. And that's what I like as well, hence why I'm not also in a rush to grow the fund dramatically. I would like to keep it small, make sure it's strong, make sure it's bulletproof, and then once I feel like I'm ready to take it to the next step, then slowly, gradually expand.
What is the hardest part of your role?
The hardest part is managing everything, the stress that comes with it, and the responsibility of dealing with large capitals for clients. Because at the end of the day, it's my responsibility, and my analysts and employees are obviously with me as a team, but it all comes down to me. I'm the person who makes the last decision. So with that stress, it's difficult, but it's worth it.
And to wrap up the episode, what would be your lasting advice to a trader that's maybe 1 or 2 years into the game?
Early days. It's quite early days. If you're not profitable, then carry on. There is always a way. There is a lot of people doing it, so you can do it too. And I don't know what your issues might be, but try to understand your problems. Write it down and see if you can find a solution to your problem. A lot of people have problems, or they might have issues why they're not being profitable, but they don't do anything about it. I feel like you need to deep dive into the problem, dissect the problem, and try to find a solution to it. It's a very difficult world. I was reading between 30 brokers, the failing rate was around 74%. 74% people failing.
Maybe even higher, with certain brokers it's even 95.
Yeah, and that just shows you that this industry is very, very difficult. And if you're getting into this industry, just expect it to be very, very hard. And anyone telling you it's going to be easy, it's not easy. I feel like this is the most difficult job there is. You're dealing with money, and you lose money in real time. It's just clicking buttons and money disappears, and you need to be ready for that. And if you're not ready, then maybe don't step into this industry. And that's for your own sake, because I've seen a lot of people lose their minds and lose their houses and crazy stuff.
In fact, I did say that was the last question, but now this reminds me. You say this, but you also started off with some sort of loan. Yeah. So I do want to understand that a little bit better.
Yeah, obviously, back then we didn't have prop firms, so we didn't have access to big capital. But obviously, I asked my dad for a loan, and that was his life savings, to be honest. And obviously, he trusted me. I showed him my work. I didn't just blindly take the money. I said, "Look, this is my work. This is my track record. I need some capital. I'm more than happy to return it with interest," which I did, But that's what I did, because I knew if I wanted to grow with my £500 capital, I would not be anywhere, and I had to take that risk. If I had access to prop firms, then I would have basically taken that route. But at that point, that was the only solution I had, and that's the way I went.
Brilliant stuff. Wonderful episode, my man. Thank you for joining us here.
Thank you very much, Waqar.
Beautiful. Boom. Good stuff, my man. Good stuff.